Bitcoin isn't dead. It's the market that's hungover, and ETFs have a lot to do with it. A few years ago, in the midst of the COVID panic, we saw Bitcoin's price drop below $5,000. Markets were crashing, stock exchanges were plummeting, the whole world was locked down, and many people thought, this is the end of the Bitcoin experiment. And then, what happened? Did the bubble finally burst, or did what followed prove otherwise? Wait a minute. Today, the story is different. Bitcoin is no longer just a toy for internet geeks. It's in regulated ETFs, on company balance sheets, in government discussions, in bank portfolios, and yet fear is returning, not because of a virus, but because of something more subtle. Massive outflows of money from ETFs, sharp price drops, and headlines speaking of a crypto winter. The question is Bitcoin broken, or are expectations broken? Today, I want to tell you what's really happening with Bitcoin, why ETFs seem to be doing more harm than good, and why we might still be facing a sharp correction within a much larger bull market. Follow me. Let's find out. I want to start with something personal. In mid-2020, at the height of the COVID panic, Bitcoin fluctuated between $4,000 and $1,000. The feeling in the air was almost apocalyptic. Traditional markets were collapsing, countries were closing their borders. Nobody knew if the financial system would hold. At that moment, the fear was existential. What if this was the end? What if Bitcoin was just a fad and never recovered? The interesting thing is that, with the benefit of hindsight, we can see that fear wasn't describing Bitcoin's future, it was describing the emotional state of the world. Because from those lows, Bitcoin reached new all-time highs, a brutal rally in 2021, another crypto inferno-like crash, and later the arrival of ETFs, institutional adoption, and finally a peak above $100,000. What seemed like the end of the experiment turned out to be the beginning of a much bigger chapter. And this is key to understanding the present. The fear you feel today doesn't necessarily describe the end of the story. Often, it simply describes the chapter we're in. Let's jump to today. Bitcoin recently reached a new all-time high above $100,000 to $120,000 per unit, driven by the latest halving that reduced the issuance of new BTC and by the euphoria surrounding Bitcoin spot ETFs, which allowed millions of people and large funds to buy Bitcoin in a regulated manner through their bank or longtime broker. Since that peak, the price has undergone a very sharp correction of around 25 to 30% from the high. And while it hurts, that's not so unusual in Bitcoin's history. In previous bull cycles, we've seen similar, even deeper, corrections before the market decided on its next move. The difference is that now there's a new player on the scene, spot ETFs. Let's get to the key point of the video. Are Bitcoin ETFs doing more harm than good, or is the market simply leveling off in the medium term? Before we get into the numbers, let me explain in 30 seconds what an ETF is and how it works, because for many people this sounds like gibberish. Simply put, an ETF is like a box containing an asset or a group of assets that you can buy and sell on the stock exchange just like a stock. In the case of a Bitcoin spot ETF, that box is full of actual Bitcoin. The ETF manager buys and stores BTC, and what you buy are pieces of that box through your broker or traditional bank. If new money flows into the ETF, the manager has to buy more Bitcoin to add to the box. If people sell the ETF and money flows out, the manager has to sell some of that Bitcoin. That's why we talk so much about inflows and outflows. They are basically inflows and outflows of money that require buying or selling physical BTC on the market. Now, let's get to the real impact. Before, if you wanted Bitcoin, you went to a crypto exchange, a wallet, or a specialized broker. Today, thanks to ETFs, a pension fund, a bank, or a traditional financial advisor can have exposure to Bitcoin without touching a wallet or a seed phrase. This has led to ETFs accumulating tens of billions of dollars in Bitcoin under management. That's a huge amount of money. And here's the tricky part. When there are inflows, when capital enters the market, ETFs have to buy physical Bitcoin to add to their accounts, and that pushes the price up. But when there are outflows, when capital leaves the market, they have to sell physical Bitcoin to return that money to investors, and that puts brutal selling pressure on the market. In recent weeks, we've seen exactly this. Days with outflows of hundreds of millions of dollars from Bitcoin ETFs. Products like the BlackRock ETF, which were the main drivers of the surge, are now registering record outflows. So, do they hurt or help? The honest answer is they do both. Without ETFs, Bitcoin probably wouldn't have reached these price levels so quickly. Before we go on, let me suggest something. If this content is helping you understand what's really happening with Bitcoin and the crypto market, I invite you to subscribe to the channel. Here you'll find clear analysis without hype or magic promises, so you can make decisions with more context and less fear. Remember that everything we share is educational content and not a direct invitation to invest. You should always do your own research and consider your personal situation before making any financial decision. Turn on the notification bell so you don't miss the next videos, and let's be part of this new financial system that's being born together. They were the ones who opened the door to a historic institutional wave, but with ETFs, the market is now much more sensitive to the whims of large managers who one day decide to cut risk, sell part of the Bitcoin ETF, and suddenly there are hundreds of millions of dollars of actual sales in the market. In other words, ETFs are an accelerator. They accelerate the upswings and they accelerate the downs. In the short term, that feels like they're doing harm. In the medium and long term, what they're doing is integrating Bitcoin into the global financial system. More liquidity, clearer regulation, more major players involved. But the price pays the price, if you'll pardon the redundancy, of that integration process. Let's go back to the comparison. During COVID, when Bitcoin was hovering around $4,000 or $5,000, the fear was, what if this shuts down forever? Today, the fear is different. How low can it fall within a system that has already embraced it? We no longer ask ourselves if Bitcoin is going to disappear tomorrow. We wonder if ETFs will continue selling, if the Federal Reserve will continue tightening the screws with high interest rates, if large funds will continue reducing their exposure to risky assets. It's a more technical and financial fear, less existential. And here's the psychological trap. If you anchor your mind to the recent all-time high, anything below it feels like a disaster, even if, at a cyclical level, it's just a large, but normal, correction within a larger trend. If you only look at this week's chart, it seems like the end of the world. If you look at the chart since 2020, you see an asset that has gone from 4,000 or 5,000 in the midst of panic to over 100,000 at its latest peak, with all the violent drops in between. What's changing isn't just the price, it's who controls that price. Before, it was crypto whales, exchanges, and retail. Now it's ETFs, giants, banks, funds, and governments, all watching closely. That makes the market seem colder, more mechanical, and sometimes more ruthless. I don't have a crystal ball, and this video isn't investment advice, but we can outline 3 logical scenarios based on what we know. Scenario 1, a micro-crypto winter within a larger bull market. In this scenario, ETFs continue to experience significant outflows. The macroeconomic situation worsens, interest rates remain high, and the market reduces risk. Bitcoin enters a sideways or bearish price phase amidst widespread fear and a narrative that the bull market is over. In this case, what typically happens is that leverage is cleared, those who can't handle the volatility sell, and supply gradually shifts from nervous hands to long-term holders. Scenario 2, a wide consolidation range. The current drop has already cleared much of the excess euphoria. From here, Bitcoin moves within a wide range. Rising periods that seem like the start of a new rally are followed by dips that feel like the end of the world, but without completely breaking the market. Within this range, ETFs alternate weeks of inflows and outflows, and the market gradually digests this new reality. Scenario 3. The underlying bull market is still alive, and this was a violent shock. In the long term, the combination of increasingly lower issuance due to halvings, institutional adoption, and governments viewing it as a potential strategic asset remains a structural bullish narrative for Bitcoin. From this perspective, What we are experiencing is more akin to a hangover after an all-time high than the asset's demise. If I had to summarize it in one sentence, I would say this: Bitcoin is not broken. What is breaking are the unrealistic expectations that an asset can rise forever without violent corrections and without consequences. In 2020, when I saw it below $5,000, no one seriously imagined we would see it above $100,000. And here we are, years later, talking about ETFs, strategic reserves, and regulation. Today, the fear is different. Fear of entering too late, fear of misjudging the timing, fear of the volatility generated by ETFs. But if history has taught us anything about Bitcoin, it's this: panic chapters are rarely the end of the book. They're often just the part where the market redistributes risk and tests our conviction. The question isn't just what the price will do. The question is, what will you do with what you know today, with what you've already experienced since that COVID crash? If this video helped you see the context a bit more calmly, let me know in the comments what the lowest price you remember seeing Bitcoin it was, and how it made you feel at that moment. In the end suggestions of this video and in the description, I'll leave a link to a more detailed video here on our channel about Bitcoin ETFs, what they are, and how they work. Please subscribe, like, share, comment, and I'll see you in the next chapter.